Hello, and this is Global Business Insights, where we look deeper at the headlines from a business perspective. Nigerian National Oil Company NNPC Limited has spoken on fuel supply shortages all over the nation. The sole importer said the tightness in fuel supply and distribution witnessed in some parts of Lagos and the Federal Capital Territory is as a result of a hitch in the discharge operations of a couple of vessels. UK Chancellor Rachel Reeves plans to deliver her first budget on October the 30th, adding that the scale of overspend by the previous government was unsustainable. Globally, oil still traded near a 6-week low as positive Chinese economic data and renewed tension in the Middle East were overshadowed by doubts over global demand. Brent crude is down slightly under $81 a barrel. And on Wednesday, the focus will be on the Fed, FOMC, the Monetary Policy Committee, where there is no expectation of a rate cut, but we could get expectations around the September cut shaped by comments from Jerome Powell. September rate cut is now seen as almost practically certain as far as traders and analysts see the outlook. The US jobs data out on Friday may also affect the data-dependent process. Also, on Thursday, the Bank of England meets to decide whether to push ahead with the first reduction in interest rates since 2020. The headline inflation has been sitting at the 2% target for 2 consecutive months, but services inflation continues to look sticky. McDonald's has been hit by its first global drop in sales since 2020 as consumers with tight wallets buy fewer burgers, fries, and soft drinks. The fast food giant reported Q2 net income of $2.02 billion or $2.80 per share, down from $2.31 billion or $3.15 per share. That was a year earlier. Also missing analyst expectations, even as we saw same-store sales declining across every division. As investors pivot from tech stocks to other sectors with room for growth, as borrowing costs come down, all eyes will be on tech earnings. More tech earnings coming out tomorrow. Microsoft will be reporting on progress in fending off competitive pressures from Amazon, Google, and others in the competitive cloud computing space, as well as more on implications and timing of artificial intelligence monetization. In France, Transport Minister Patrice Regret promised a complete return to normal of rail service today, adding the disruption that was seen in the last few days did not affect the ongoing Olympics Games event. LVMH is spending big, but another major company has pulled out its advertising. For US lawmakers, renewing and extending the Africa Growth and Opportunity Act pact may be emerging as a tough task, as the very divisive politics may be holding passing the bill hostage. And Ethiopia plans to float its currency, the birr, as part of ongoing macroeconomic reforms, according to Prime Minister Abiy Ahmed. The announcement comes a day before an International Monetary Fund meeting at which the Washington-based lender is expected to discuss Ethiopia's request for a new financing program. Egypt also raised prices on a wide range of fuel products 2 days before the IMF conducts a third review of Egypt's expanded $8 billion loan program. And in Nigeria, uncertainty is rife as the planned nationwide protest kicks off on August the 1st, even as the federal government and many other agencies of government continue to work to see that the pending protest does not materialize or is peaceful. Welcome back. NNPC Limited, their performance as sole importer of fuel products is coming under fresh scrutiny as widespread shortages led to long queues at filling stations. The Dangote refinery, said to be in pre-commissioning stage, had voiced all sorts of crude supply issues, even as some suspect it is also plagued with working capital challenges, and there may be more we do not know, as its short-lived honeymoon with NNPCL seems to have fallen apart. It's still a case of conflicting stories. NNPCL has not been able to revive its aged refineries, as observers opine that it simply does not have the capacity to operate these refineries, only to be pouring millions of dollars at repeated efforts to get the refineries to work. The inventory of petrol products have run down, as import hitches and other supply chain challenges leaves NNPCL appealing for patience to get its supply of products back on stream. Analysts observing are worried that the entire oil and gas value chain in Nigeria may be facing severe deterioration, impacting perhaps the downstream sector more. But Nigeria has struggled even to meet OPEC quotas in the upstream with all the several leakages. The government needs to stop playing the ostrich with its neck buried in the sand and must immediately commission a comprehensive independent review, and more importantly, execute bold change actions that will entail a fresh reimagination of the oil and gas sector, putting it back on a sustainable path. There are no shortcuts, nor will the problems simply fade with time without very major comprehensive corrections. US lawmakers who support a renewal of the Africa Growth and Opportunity Act, AGOA, assured South Africa and other African countries in Washington last week at the 21st Africa Growth and Opportunity Act Forum in Washington that they would lobby for its extension. US senators told the South African delegation, led by Trade, Industry and Competition Minister Pax Tau and a host of business leaders, that there was a strong desire to reauthorize AGOA, but this process could not be concluded yet. The process of renewal may have been held hostage by the divisive politics. Trump prefers to pick and choose individual countries to deal with, shunning multilateral broad brush trade pacts, and may expect more back from countries like South Africa, saying to be more pro-China, while the Democrats are already sold on the act, even though it has yet to prove it delivered significant gains. If passed, the bill tabled in the US Senate in April would extend AGOA by 16 years, which would see it expire in 2041. Granting the scheme a long extension would also instill a sense of certainty for investors who may want to invest in African countries to benefit from the preferential trading scheme. The last 2 years have seen tensions grow between the US and South Africa over South Africa's perceived anti-US foreign policy, which is one of the conditions which can render a country ineligible for AGOA. And that, of course, has triggered a series of reactions from the US legislature, even at a time calling for a review of South Africa's AGOA status. As the trend towards unilateralism grows, deals like AGOA are at risk, worsened by colder East-West relationships and forcing countries to take sides or be isolated. A bigger theme in Africa beyond trade is the pain associated with the reform and dissatisfaction with the governance, which oddly plays to the advantage of many in the US who see Africa as its own worst foe and who argue that trade pacts should not be propping corrupt or at best inept governments. LVMH is one of the Olympic Games' largest benefactors, with a sponsorship deal reportedly worth $166 million. According to reports, the Games raked in $1.31 billion in total sponsorships. That's 60% higher than what it earned at the pandemic-afflicted Games in Tokyo. Like we said in a previous chat, few Olympic outings have come within budget or turned a profit. Paris Games have avoided updating the spending budget of $9 to $10 billion, with the latest estimates reported not to factor in about 45,000 security personnel, compensation for shops shuttered for a week in parts of the city behind police cordons, or the $1.4 billion project to make the sign swimmable. While LVMH is definitely in, a major US tech company has pulled its advertising from the Paris Olympics. On Saturday, Mississippi-based C-spire pulled out its advertising sponsorship following intense backlash over a performance during the opening ceremony that many viewers found deeply offensive. The controversial act involved drag queens and dancers in a performance perceived as a mocking parody of The Last Supper. The International Olympics Committee has apologized, adding it intended no offense. The IMF starting today will review Egypt's progress, also promising another $5 billion in the next tranche of support if satisfied after the review. But some have been asking of late, does the IMF cause fires or does it put them out? Indeed, every country debt situation tends to be unique. In some cases, root causes behind fiscal challenges could be bad leadership and governance, while in others you could have a shock, for example, COVID, or an absence of fiscal buffers throwing finances into chaos. A recent critique of the fund says the IMF should move away from the failed neoliberal economic model and immediately stop imposing outdated austerity policies and constraints to public sector wage bills that undermine urgently needed investments in health, education, and responses to the climate crisis. IMF offers affordable funds but insists on better use of those funds. The IMF is like a bad loans bank. They are brought in to put finances on a better sustainable fiscal position, and perhaps over 50% of interventions will fail. However, to blame the IMF for strategic failures like inability of countries to invest in infrastructure, education, in many cases shows a misunderstanding of the rescue mode of IMF's operations. IMF expects its conditions to be met, reducing cost of governance, asking people to pay their taxes and for services, reducing general subsidies and replacing with targeted interventions to help those unable to pay. No one is forced to meet these conditions or to go to the IMF, and IMF conditions, of course, can be negotiated. The attraction is the huge difference between borrowing at 3% and issuing bonds at over 20%. To blame IMF for failure under poor governance is just ludicrous, and austerity is not always bad. It's a fancy word for cutting your coat according to your cloth. In short, the sooner countries own their own issues and be accountable and disciplined to correct their fiscal excess and stop demonizing the external advisor or surgeon, I think the better. European markets were higher as investors digest US inflation data plus another week of earnings and central bank meetings. Philips shares were up 15% after the company posted better than expected second quarter earnings. Heineken shares, however, fell over 8% after first half profit growth came in weaker than expected. US markets are lower ahead of the latest policy meeting from the Federal Reserve. President Joe Biden today also unveiled a set of reform proposals to overhaul the Supreme Court, including term limits for justices and a more binding ethics code. Well, that's it from me on Global Business Insights. This is Bode Oshosami. Thanks for sharing and following or subscribing on Facebook, LinkedIn, or YouTube and X. Please send your comments. Again, thank you so very much for watching. Bye-bye.